crash is one of the hardest thing to do, and most people who try to do it always fail. So in this video, I'm going to show you a very simple strategy that you can use to maximize your chances if you try to scalp, boom, and crash. So let's get started. So first of all, should you scalp, boom, and crash? There's 3 points that I want to talk about. Number one is, yes, you can scalp, boom, and crash, but it can be dangerous. Why can it be dangerous? Because most people, when they try to scalp, boom and crash is going to give you unpredictable risk to reward ratio, because you always know what the small tick candle is worth, but you can never know what the scalp is made of and how big it can be, right? So most people will put a lot of money on these small tick candles, but when the spike comes, it eats up all the account, and I'm going to show you why in a minute. Number two is, you won't make huge profits when scalping, boom, and crash. Why? Because of the unpredictability of the risk to reward ratio. So you can't really plan in a long term. But if you want to make money in a short term, there's high chances that you can place your trades and make some small profits in a short term using boom and crash. So it's completely based on algorithm. That's number three. This market is not controlled by humans. There is no human psychology controlling this market. This is an algorithm. This is a computer created market. It's a simulation of the market. So you need to keep that in mind. Don't put all your money in boom and crash, and also try to do small trades when trading boom and crash, because you don't want to risk thousands of dollars trading on a simulated market. Now, if you place your trades with the one standard lot, here's what happens with boom and crash. These small tick candles right here is going to be worth 50 cents per candle for one standard lot. So if this one small tick candle is created and you were using one standard lot, you will make 50 cents, right? But the spike can be worth $3 to even up to $10 at some point. So there's going to be some huge spikes, but most of the time it's going to be worth like $3, $4, or even $2 or $1, or even less. But then, because you can see there's different sizes of these spikes, right? So you don't want to be placing a lot of trades, because think about, if you risk like 20 lots because you want to make $10 on one small tick candles, but what if the spike comes and it's 3 times or 4 times bigger than your risk? So you are trying to make $10, but you are risking like $60, because you never know how big the spike is gonna be. That's why most of the people who try to scalp, boom and crash always lose money. So if you are trying to scalp, boom and crash using this strategy, one rule that I want to give you is that just try to make 4% or 5% of your account per session on your trade. So if you have a $100 account and you are scalping here, you just want to make sure that you take 2 or 3 trades and try to make like $4 or $5, and then you go away from this market, because since this is a simulated market, there can be a way of tracking how you are winning, and we never know what happens, because this is a computer created game. So anything computer created can know that, okay, let's trap this guy, let's make him make $20, and then at some point let's just take $50. So I'm not saying you should never trade boom and crash, but I'm saying, since this is a computer based algorithm, best way is to just get in and get out as fast as possible before the computer recognize your pattern of trading. So if that sounds very clear or very understanding, let's move on to the strategy and let me show you how to place your trades. So what you want to do is, we want to try and capture these small tick candles. So we are not looking for spikes, we are looking for these small tick candles. And for us to trade these small tick candles, what we want to do is, we want to say, if we are in a boom market, we only sell because we want the small tick candles. If you want to buy, we only buy in a crash market because we want the small tick candles. So we will start with the boom 300 index here. So right now you can see that the market has been moving to the upside. So first thing, the first rule that we want to see is the market moving to the upside like this, creating a lot of spikes. Once it creates a lot of spikes, you want to do what I always talk about, which is mark out these zones where the market was creating lower highs. So the market is pushing up, pulls back, push up, pulls back, push up, pulls back here, and makes to the downside. And then you want to wait for the market to break to the lower side and then you want to scalp a little candles right here. So let me show you. So once you mark out this zone, the next thing that you want to do is you want to, if the market starts closing below this zone, we want to place a sell trade right here, because what happens right here is most people will try to be getting these spikes, right, and they will treat these zones as levels of support and resistance, right? And since this is a computer generated market, we want to oppose what other people are doing, because we know that automatically there is no way that this was created for you to make money. Of course, it was created because this is a market. When you are involved in the market, it's either you are the one who are making money or the other trader who's on the other side, right? So what we want to do is want to oppose what most people do here. So now when the market breaks below this zone, we want to sell, and we want to take 4 to 6 candles, these small tick candles. So if you use one standard lot, if you get 6 candles, right, it's going to be $3, and we are almost at our target. If you are using $100, of course, and we are trying to make 4 to 5% per day, right? So you can just look at this, and you can see that after this breakout, the market went to the downside because it broke below here, and the market always fails to spike after. The market almost always fails to spike after a breakout of its previous zone here. I don't know if this is a mistake from this market or what is happening here, but I found out that if you see a market creating big moves to the upside like this, and then it breaks below this zone, there's likely chances that the market will reverse. So if you mark this zone here, you can see that, okay, the market pulls, it makes a spike here, and then it breaks below this zone, it will likely go to the downside. So in this case, you can see that where the market is at right now, as I'm recording this video, we already had an opportunity to get 1, 2, 3, 4, 5, 6 candles, and it was like $3 if you are using one standard lots. If you are using 2 standard lots, this will be $6 and you'll be done for the day. You can place 1 trade per day with this market and still make money. Let me show you another example. We said rule number 1, make sure you see a big move with a lot of spikes. Don't trade before you see a lot of spikes. Start by seeing a lot of spikes. You can see here a lot of spikes, and if you start seeing this a lot of spikes, you are going to be able to identify these previous lower highs. And then in this case, this was our zone, and then we see the market pushing down and breaking below this zone, and we are likely to see the market pushing. And if you look at the higher time frame, you might find out that this market would be in a long-term downtrend. So in this case, you would place a trade like this, and then you would let the market push to the upside. Now let me talk a little bit about it spikes right here. The first spike that you get most of the time, you want to get out of the market. So the stop loss here is just to remind you that if the market spikes against me, after a spike, whether the spike comes above your stop loss, you just get out of the market. You always get out. If the spike goes above your stop loss, you are going to likely get out with a bigger loss than you wanted to. So the risk to reward ratio here is not an issue. But if the spike happens and then it doesn't go up to your stop loss, you let the market keep going to the downside. You don't exit. But if the spike goes above your entry and to your stop loss, you exit, no matter if the loss is bigger than what you wanted, right? So let's look at another example here. The market is pushing to the upside, and then we are marking these zones. We could have also marked out this zone, right? So I marked the wrong zone here. I missed this trade. You could have marked this zone, placed the sell trade here, and made money to the upside, because this uptrend is exhausted. But then let's look at this. The market again breaks up below this zone right here, and then you were placing a trade here, and likely you were going to win this trade. Now this was a boom market. Now this is boom 300. You use this on boom 300, boom 500, and boom 1000. But what if it is a crash market? So let's look at some crash market example. Now this is crash 500, and you are on crash 500 is just the opposite. Now you are placing only buy trade. Why are you buying? Because you want to take advantage of the reversal after a big move of spike like this, because it always happens in any market. After a big move going to the downside, you have to reverse. The market have to reverse without negotiation, right? So now you can see the market is going to the downside, and what you want to do is you want to be able to mark out these previous zones right here, and you want to wait for the market to break above here, and then you buy and you catch 4 to 6 of these small candles, and then you get out of the market. So in this case, just mark out this zone, wait for the market to move up, and then it breaks above this zone right here. Once it breaks above this zone, we want to place our trades right there. And then if that happens, sometimes you will lose, but most of the time you are going to get in a winning trade. If you get, so here we go to 1 2 3 4 5 6. So we should have gotten out of the market right here before this big spike right here. But then you can see this spike happened, but then this spike didn't go to your stop loss. So if this spike had went down maybe to this point, you could have exited here. It didn't go there. Number one, you should have already taken out your profits. But I'm just saying, if this spike comes and then it doesn't go all the way down, and it comes within the range, there's chances that still you can make money with that trade. That's how the trade goes. Here's another example. Can we mark previous zones here? It's easier. Why? Because this market, you have just spikes and pullbacks. So you can see, okay, after this move, this is where is the previous zone, right? So where do you mark here? After the last spike. So just want to mark the top of the last spike that went before the reversal. And then you can see the market pushes to the upside. If the market managed to break above this last spike, it is likely that the market will keep going to the upside. So you can see here, the market pushes to the upside, and then later on the market goes. So you catch here 1 2 3, and then we have small spike here. It fails to go to the downside right here. Look at this. We almost had a spike here but didn't come because this market failed to create a spike soon after breaking this zone. This is why I think this strategy is working. Maybe the algorithm will change, maybe something will change, but for now this strategy is working very, very well. Here you can see we managed to get a winning trade.